Hi, John Rapaski with the Counsel Mortgage Group. We're going to talk about the asset test. It's an acronym I came up with and trademarked, which has all the elements of a loan. Every single residential loan has A for assets, C for credit, I for income, D for down payment. All four of those elements are required in any loan. And you need to be strong in all of them. If you're strong in all of them, you'll get a loan. If you're weak in any one of those elements, you may not get the loan. So let's break it down. A, assets. That checking accounts, savings accounts, investment accounts. They want to see that you have money in the bank. They want to see that you'll be able to make mortgage payments. They're going to ask for typically at least a month or 2 months worth of bank statements and retirement account statements. They are looking at large deposits in these statements. If you have any large unexplained deposits, they're going to want to know where those came from, so be ready to have that documentation ready. So that's assets. C, credit. You need to have a good credit score. Credit scores, the minimum scores kind of vary depending on where we are. Right now, a lot of people like to see 620 as a credit score, but some people do loans as low as 580 or even 550, but those are definitely on a case-by-case basis. What they look for is the tri-merge credit score. So they're going to look at Experian, Equifax, and TransUnion, and it's the middle score of those three that is going to be the credit score that the lender uses. Let's say that you have somebody else on the loan, husband, wife, or brother, sister, or two friends or partners are trying to purchase a home. Of those two people, they're going to look at the lower credit score of the two people. So if one person has a 700 and the other one has a 650, middle scores for each, they're going to use the 650 because they're looking at conservative. So credit's important. They're going to also look at your credit history. They're going to look at collections and judgments, and those, if you have those, that could lower your score. And you may think, well, you know, maybe I want to go ahead and pay those to try to improve my score. Don't move so fast. Call us first on that, because just paying off those collections or just paying off those judgments may initially not improve your score. It may actually go down. Let's take a look at it before you do something like that. And that's credit. Income. Well, most loans today are done by full documentation. So we're going to need to have 2 years tax returns, 2 years W-2s, 2 years or 2 months pay stubs, things like that. If you're self-employed, they're going to want to see your business returns. They're going to look at your net income, not your gross receipts, but your net income after all your expenses. If you're salaried and you have a lot of expenses that you write off on your tax returns, they're going to want to see your tax returns because they're going to subtract those unreimbursed employee business expenses from your income when they're calculating their income. So they will ask for tax returns even if you're not self-employed and you're a salaried employee. They'll also consider other income such as dividends and interest, any retirement distributions from your retirement accounts. If you have investments in partnerships or corporations, all that stuff can be considered into income, and we take a look at that by looking at your tax returns. The final element of every residential loan is a down payment. And except for a couple exceptions, you're going to need to have a down payment. There are a couple loans, VA loans and USDA loans, that are no money down, no down payment needed. You still may have to come up with some closing costs. But, and those are fantastic loans. So veterans, definitely, and we've brokered many veterans loans over the years. Go ahead and let's work on trying to get you one of those loans. You'd have to get two things for veterans: the DD-214, which is your discharge, honorable discharge paper, and your certificate of eligibility. USDA loan is a farmer's loan. That's also traditionally known as the farmer's loan. It's rural housing, and that's also no money down. There are income and geographic restrictions on that loan. But those are the two no money down loans that are out there. Other than that, you're going to have a down payment, and we're going to have to show it. FHA requires 3.5% down, and here in Maricopa County, today the loan limit for FHA loans is $271,050. Conventional loans require 5% down as minimum down payment, and the conventional loan, in my opinion, is a better loan than FHA. Many lenders will try to talk to you about FHA loans rather than conventional, but give us a call, and I'll talk to you about why conventional is better. FHA, there's upfront mortgage insurance and monthly mortgage insurance, where conventional, it's just one or the other. So the mortgage insurance factor is lower, and typically your payment's lower, and you can get out of mortgage insurance in a conventional loan, where in an FHA loan, you're in it, and it's going to stay with it for the life of that loan. Jumbo loans, generally 20% down, although we do have some sources that do 10% down. And jumbo are any loan amounts over $417,000. And the other thing that goes into down payment is what the purpose of the loan is. If it's your primary residence, we just went over those down payment requirements. But if it's a second home, they're typically going to require 10% down. And if it's an investment property, the general rule is 20% down. There are some lenders that'll do 15%, but the general rule is 20%. So there you have it. Those are the 4 elements of every single residential loan. Assets, credit, income, down payment. You're solid in all of them, you can probably get a loan. We can take a look at it. Give us a call, 480-502-1000. Thanks.